What's going on, everyone? So it's raining in Southern California today, so I had a bit of free time. And I've been working on my taxes using TurboTax for the past, honestly, like 3 weeks. And many of you don't know that I've been doing my own taxes despite owning 90 units of real estate, despite owning two businesses, and despite working at W-2. I actually do my own taxes on TurboTax since 2017. And a lot of people ask me, like, why do I do my own taxes? Like, shouldn't you outsource that? It may cost like $600. And my response has always kind of been, well, for me, I like doing my own taxes because it helps me learn. I like doing my taxes so that eventually when I do outsource my taxes, I will be more educated and know how to check. And, for me, I've been kind of doing my own taxes on TurboTax. TurboTax has great forums where you can ask questions, and people have been through similar situations. TurboTax has great ways of explaining things. Yeah, I'm not sponsored by TurboTax, not yet, but been using it for since 2017, and it's been pretty user friendly. And what I do is kind of a little bit hack, but I basically schedule like the 15-minute free calls of CPAs. And if I have a specific question that I have about my taxes, I will ask them, right? And then I can kind of get clarity in that nugget. And for me, my uncle, he's been doing his own taxes for I think 30 years now. He owned his own consulting business. He owns I think 9 units of real estate. So anytime I have questions about tax write-offs, I always talk to him. And I have a little bit of a kind of a law background, being working in a hospital pharmacy setting. For those of you who follow my story, I'm a pharmacy director, a pharmacy leader. So we deal with a lot of regulatory. And just like with anything regulatory, it's a lot of gray. There's a lot of confusion. There's a lot of um, kind of confusion in gray areas. And to me, like, I'd say organically, since I've been doing my taxes myself, I've just slowly learned, and my situation got a little bit more complex every single year. So let me backtrack, right? So, prior to 2017, I just had a W-2. So, if you just have a W-2 job, your taxes is pretty easy. You just can buy the TurboTax for personal tax return. And it's pretty easy, right? So typically it's going to ask for your, W-2. Let me pull up my TurboTax just so I can remember what to talk about. But pretty much it just asks you, okay, what's your W-2? And it actually can import it. If you have electronic PDF of your W-2, you can upload it onto TurboTax, and they will actually transpose information for you. But if you have a paper copy, it's pretty easy. You just ask you, okay, put in the information for box number 1, box number 2, box number 3. At that point, if you have any interest from banks, so it's typically a 1099 interest form. So it's 1099-INT. So let's say you have Chase Bank or Ally Bank, whatever it is, at the end of the year, you have to compile all your interest, and then you will report that, right? Or you can link your bank account. So let's say you log into Chase, you link it to your TurboTax, it'll take your 1099 INT information and transpose that for you, and you have to pay taxes on that. The next one is the 1099 div form. So I do have like Vanguard, where I invest in stocks with after tax dollars. So I do Vanguard. I have Charles Schwab, which is just honestly Vanguard, but I use Charles Schwab because I have a pledged asset line of credit on that, right? So whatever dividends you get paid. So for example, my index funds, they pay dividends once every quarter. And so basically that money that I get gets reinvested in buying more stocks, and that is taxed as ordinary income, right? So the 1099 for interest and the 1099 for div is taxed at your ordinary income tax bracket, right? And if you have any stocks, cryptocurrency, any capital loss carryover. So let's just say I sold some stocks, I lost $10,000. It would then at that point offset, my W-2 income, right? So, here it's pretty easy. If you have like an S corporation, then typically the S corp will issue a K1, and that K1 document is what you would put in, right? So for example, for me, I own a pharmacy, or I'm a part owner of a pharmacy, and it's losing money. So every year when I get a K1, it is negative. So once I put that negative K1 in, it offsets my active W2 income, right? So let's just say, for simplicity, between my W2, between my interest, between my dividends, I made $100,000, and my K1, after all compiling all the income and expense, I'm negative 10,000. That 10,000 gets offsets my $100,000 income, so I'm only taxed on $90,000, right? So that's one thing that was like kind of eye-opening for me, because for my business tax return, so for me, I use the TurboTax home and business because I own a bunch of LLCs, which owns a bunch of real estate. But I am a single member LLC, so all my LLCs are single member LLCs. I don't have partners on them. It's just me. So what happens is the money goes, let's just say I make $1,000. What is it? $200,000 in rent, $100,000 in expenses. I make $100,000 in net profit, and that goes into my LLC. But since it's a single member LLC, for tax purposes, it's considered a disregard entity. So those funnel into my personal tax return, right? So when I'm doing the business tax return, this takes the most amount of my time, right? So for your tax return, if you own a business, so for me, I own a coaching and mentorship program, and I'm not big enough yet to own an S corp. So I'm a sole proprietor on my coaching and mentorship program. So what happens if I make, let's say, $10,000, then I'll have to pay taxes on that money. The next one is the rental properties. So this usually takes me the most time. Let me turn on this light a little bit. So this usually takes me the most time, but I basically compile all my rental properties. And what's nice about the rental properties is you do it one at a time, right? So let's just say I put in my first property, 123 Main Street, and let's say it's in California, San Francisco, California. So I'm basically doing that. And at that point, what you do is you want to update they're going to ask you information about your property, right? So they're going to ask you, okay, what's the address, right? And at that point, they're going to ask you, okay, what type of property is it? Is it a single family home? Is it a multifamily? Is it a vacation or short-term rental? Is it commercial? Is it land? Is it self-rental, right? There's a lot of questions that it's going to ask you. At that point, it's going to ask you, okay, did you sell the property in 2023? If the answer is no, you don't check it. Did you convert this property from personal use to rental use, right? Like, let's say I was house hacking it, and then I ended up moving out of it. And then at that point, I converted it from personal use to rental use, right? So there's actually another caveat to that, which I'll go into. And then, are there any carryovers, right? So are there any passive losses from the last year, right? Like for me, I have passive losses from the last year, so you can carry that forward. And I forgot to say at the beginning, but I'm not a CPA. I'm not a tax expert. I'm just a guy who's done my own taxes for, since 2017. So check everything that I'm saying, or you can go on TurboTax yourself or consult a CPA, right? So when you house hack it, it's interesting. There's a section where you rent out a part of your house. So let's just say that I have a 4-bedroom house. I live in 1 bedroom, rent out the other 3 bedrooms. So what that means is 25% of that house is considered a primary residence, and 75% of the house is considered a business, right? So I think the difference is, I think if it's a primary residence, it's a Schedule A. If it's an investment property, it's a Schedule E. So if you had, let's just say, I'm just making up numbers here, $1,000 in expenses, 25% was for personal use, so you can't write that off, and then 75% is for investment use. You can write that off, right? So some key distinctions is, so you could say that you can break it up, right? So for me, I usually do it by the bedroom. When I was house hacking and I was doing my taxes, I basically broke it up. So I lived in 1, I rented out the other 3. So 1 out of 4, I owned it for personal use. So 1/4 of the house was personal use. So 25% personal use, 75% was business use, right? So that's with house hacking. Now, if let's just say I was, let's say it was house hacking, so I had partial personal use, but now I rent out the whole house. Now I convert from personal use to 100% business use, right? So you want to document that date, that when you convert it from a personal use to a rental use, or vice versa. If you want to go from rental to personal, right? So you'll go through that section, and then, like you said, if you have any passive over losses on your Schedule E, So for one of my properties, for example, I was negative 27,000. I carried that forward, right? So, at that point, let's see here. You would go through it. It's going to ask if you actively are you an active participant in the real estate property? So to be defined as an active participant, I always click yes to this. You must own at least 10% of the property. That's easy. I own 100%. And I made major decisions for this property, such as approving tenants and authorizing repairs. So I do that, right? It's easy. So you always put yes, right, for active participant. And if you make, I think below $150,000, I think they let you write off up to $225,000. Kind of on a sliding scale. Like don't quote. I think from 100 to like 100K to 150K, you can write off 25K on a sliding scale basis. So when you punch it in, it'll do it for you, right? So key message is just make sure that you put down that you're active participant. So let's see. So that's the first section, right? And like I said, TurboTax, they do things step by step for you, so it's not as bad. The next one is you want to do your rental income, right? So this one's pretty easy, right? If I made $1,000 a month, then you times it by 12, then I made 12,000, right? In terms of expenses, they have so many different categories for you. So you have advertising expense, your travel expense, not including auto. So let's just say I need to fly to Oklahoma to view my apartment complex. That's a travel expense. If you have any cleaning or maintenance, so cleaning and maintenance, they actually have definitions. So basically examples would be like gardening, pest control, pool cleaning, house cleaning service. Any commissions you paid to any leasing agents, sales agents, how much was your insurance, any professional fees, like let's say you have to do your taxes. That's a professional fee. What's your management fee? Do you have property management? Any repairs? Any supplies? Real estate taxes, other taxes, and utilities, if you cover that, right? So they walk you through it. And of course, you want to put your lender and how much interest you paid for the year. So those are kind of your typical expenses, right? And then they ask you if you refinance your property. If the answer is yes or no, if you refinance it, you can actually depreciate that refinancing cost over a few years. So that's you have your rental income, you have your expenses, and now we're going to talk about depreciation, right? So for depreciation, this part was probably the hardest part for me to learn. But pretty much what you do is when you go under depreciation, you want to click add asset. So the first one that you're going to do is something. So there's 4 categories of depreciation. There's rental, real estate property, which is broken down into land improvement, real estate property, rental property, appliances, carpet, and furnishing. There's one for computer, video, photo, and telephone equipment. There's one for tools, machinery, equipment, furniture, and there's one for intangible other property. So TurboTax will actually give you categories. So for example, if you were to you refinance a property, those mortgage points, it's under intangible other property, right? So do your best, but most of the depreciation, to be honest, is rental real estate property. So you'll click continue. And then from here, they're going to ask you, is it residential rental real estate? So this is where you have to look at your tax return and see that, okay, I bought this house for $1 million, and you want to know, okay, what's the land versus what's the structure, right? The land is, let's just say for simplicity, you bought for $1 million. The land is $500,000 and the structure is $500,000. So you can only depreciate the structure, which is $500,000, over 27 and a half years, assuming you're not doing something accelerated, right? I'll talk a little bit about that later, right? So when you punch in your residential real estate, you want to pull up your most recent tax return. And then you pretty much want to say, okay, what's the cost? So it's going to be $1 million. What's the cost of the land? That's $500,000. So the structure is going to be $500,000. And that's what you divide over 27 and a half. And that's what you would depreciate, right? So that's the first one. So just kind of doing that math for this example. So you take $500,000 divided by 27.5. So roughly you can write off $18,000 a year as paper losses, right? So let's just say, hey, you're renovating your property. Like, where does that go, right? So for me, it wasn't as intuitive, but I clicked under appliances, carpet, and furniture, right? So for this one, you clicked on this one because, like, for me, I renovate, like, let's say like a whole unit, right, or a brand new kitchen. So once you go under this, I would describe it. I'll say kitchen renovation, and for me, I just did a lump sum. So let's say it cost me $30,000 to do the kitchen renovation, right? So I would document, okay, kitchen renovation cost me $30,000, right? And then what's nice about this is you can enter that into TurboTax, and then they're going to ask for a date. So I usually put the date that I start renovation. So if I start renovation on September 1st of 2023, that's the date that I'm going to put, right? So here, and then they're going to ask you after that, what percent of this renovation was used for business? So for me, because it was a full-on rental property, it's 100%, right? So it's basically 100% for me. So I'm just running a simulation here. Sorry, I would love to show my own tax returns, but it's a lot of personal information. So I'm just kind of like looking at my tax returns as I'm teaching this. So what's kind of cool is, okay, so let's just say you spent $30,000 for your renovation for your kitchen. And then from this point, TurboTax will ask, how do you want to deduct this item? Right? So you can say, hey, I'll spread this deduction over several years. And for renovations, it's over 5 years, right? I know that because if you click further, it'll tell you it's 5 years, right? And they said, this is recommended if you anticipate having greater income in the future and want to reduce your taxable income at that time. For me, I have so many passive losses that I'm carrying forward. I don't qualify as a real estate professional. So for me, I don't need the whole lump sum of $30,000 this year. I'd rather spread it out over the next 5 years. And what happens is, even though I'm writing off, let's say 30,000 divided by 5 at $6,000 a year, it just carries forward for me, right? Or you could do they call it Section 179, is I'll take the full value of the item this year. And this is recommended if you're showing a profit, right? So you can, option one, let's recap. You can take that $30,000, depreciate over 5 years. So $6,000 a year for the next 5 years. Option two is you can deduct the full value of this item this year using a Section 179 deduction, right? And this makes sense. Is let's just say you have one property that's cash flowing so well, and you want to offset it, then you can depreciate that $30,000 all this year, right? Or you could take a partial Section 179 deduction this year. So what happens is your asset's worth $30,000. You can say, hey, I want to take $15,000 this year, right? So 15,000 is left, and that 15,000 will be divided over the next 5 years after that, right? So you can get really creative and play around with it. For me, I like to keep it simple. So I just, honestly, would probably just spread it over a few years, or I would deduct the full value of the item this year. But for me, I've been spreading it out, right? So let's just spread it out for this example. Once you click through it, what's really nice is they give you a summary at the end. So this says that right here, your estimated expense for this asset, $6,000. So they'll show you a summary. Hey, I spent $30,000 for a kitchen renovation. It's divided over 5 years. That's $6,000 a year, right? Or if you, let's say you want to take the Section 179 and take the full value this year, you click that option. You will click continue on TurboTax, and then it'll say, your 2023 estimated expense for this asset is $30,000. And then if you click show detail, it's going to show 1 year. And then it's going to show that if you look at under special deduction, it's going to be the Section 179, right? So, once again, to summarize, if you have a lot of income you want to offset, the Section 179 is favorable. You defer the taxes. Or if you have too many passive losses already, like me, I prefer spreading it out over, a couple of years, right? So that's how I kind of do that. So for depreciation, let's kind of take a step back. We talked about doing for the actual property itself. So remember, it's the cost. So let's say it's $1 million minus the land, which is $500,000. The structure is $500,000. You divide that by 27.5. That's $18,000 for the next 27.5 years. If it's a kitchen renovation, typically it's going to be over 5 years. So if I spent $30,000 to renovate my kitchen, and you want to spread it over 5 years, then $6,000 a year, or you can do the Section 179 and do it the whole year. And let's say you did, I haven't done a land improvement yet, but this is how easy TurboTax is to use, right? So let me show you. So, I'm kind of curious for myself. So let me do a land one. So I'm going to run, I think it's 15 years for some reason. I don't know why. Yeah, actually, so typically land is just, let's just say that I, added a brand new lawn and it cost me $20,000. And then you put in that cost, and once again, it's going to ask you, like, how do you want to depreciate it? actually giving me error message and not letting me go through. But I think it's 15 years. So what I'm trying to say is it's pretty user friendly. The refinance fees, let me see how that was amortized. Right. So so basically from here, from this depreciation section, typically on paper, you look you'll be negative, right? And then for vehicle expense, so for me, I drive to my rental property maybe once a quarter. So I'll add up the mileage from my house to the rental property and back, and then I drive there 4 times once a quarter. So I times it by 4, and I usually do the mileage expense. And I think I want to say the deduction for the mileage is about 65 cents per mile or 63, something like that in the 60s. It used to be like upper 50s. Now it's like low 60s. So to summarize, your rental property will have, first of all, your rental income, right? You'll have your expenses. You'll have your asset depreciation, which includes your structure, divide by 27 and a half years, any renovation, divide by 5 years, or any refinance points, divide by 30 years. And you have any vehicle expense if you're, writing off your mileage, right? So what happens is TurboTax will summarize all this. So you have your income, your rental income, minus the expense, minus the depreciation, minus the vehicle expense, and then you'll have your final sum of the property at the end, right? So at the end, it'll say, hey, your net loss on this property was negative $7,000, right? So basically, when you have multiple properties like me, you'll start to see the compile. So for me, my first rental property, one rental property is negative $7,000. My second rental property is negative $43,000. I have one that's positive $6,000, one that's positive $14,000, one that's negative $2,000. My 26 unit is negative 67K because I did a lot of renovations. That's being depreciated. My mobile home park is negative 170K because I lost money on that deal. And my 20 unit is negative 45K because I did a lot of renovations as well, right? So at the end, it'll summarize it, and I'm negative 315K, right? So that seems like an intimidating number. And what happens is that negative 315K, because I'm not a real estate professional, right? Because I work a full-time W-2, I'm not married. If let's just say I was full-time W-2, I was married, and my wife was in a real estate profession, we would qualify together as a real estate professional. And what happens is, let's just say I just told you I'm negative 315K through all my real estate after all the depreciation and all the income minus expense minus depreciation. And let's just say for simplicity, I made 315K on my W-2 job, right? So because I made 315K actively, but I have 315K in passive losses through real estate, but I'm a real estate professional, those will offset. So whatever taxes I paid, I will basically get back. My effective tax rate would almost be zero because I've made 315K and probably paid about, let's say 50% in taxes. So for simplicity, let's just make it, I paid 150K in taxes off of my $300,000 income, but I have $100,000 in passive losses on my real estate. If I'm a real estate professional, those two offset, and I'm going to get a refund of my 150K when I file my taxes, right? So that's how people, when they say they pay zero taxes, that's how they do it. They basically have a bunch of depreciation from real estate, and it offsets their income, right? That's how people pay zero tax. That's how you do it, right? So for me, I don't qualify as a real estate professional. So what happens is that negative 300K just carries forward every single year. So let's just say right now I'm not a real estate professional, but let's say when I'm married, have a wife, I do qualify as a real estate professional. At that point, that negative 350K, let's say it piles up. Let's say I'm negative 315K. The next year I'm negative 400K. The next year I'm negative $500,000. And all of a sudden I qualify as a real estate professional. At that point, let's say I made 300K, I will basically wipe out my whole income and still have negative $200,000 to carry forward again to the next year, right? So that's kind of the tax advantage of investing in real estate. So for me, I don't get it today, but it carries forward into the future, right? So that's what's nice about having these passive losses, right? So another thing that I did was I sold my mobile home park. So for me, this was something new for me for this year, to be honest. So I was spending a lot of time, basically doing this. But what's kind of nice about this is like this was the hardest one for me, but after I did it and I looked on TurboTax forums to figure it out, it was pretty nice. So basically, when you go through your questions, there's one question that says sold. I sold or disposed of this property in 2023. Then you check the box. And then it'll say you'll enter the details of the sale when you reach the depreciation section later, right? So you have to do this in the depreciation section, right? And this is the part that really confused me. And hopefully I can make it easy for you to understand if you want to sell an asset and then also like do your own taxes, right? Um, so here I went to depreciation, and for me, I was confused, right? Because I have multiple things going on in my depreciation. So basically, I have the once again the structure depreciate over 27.5 years. So for example, my mobile home park, I bought it for 1.1 million. The land was worth $1 million and the structure was worth $100,000. So you take that $100,000, divide it by 27.5 years. So I was writing off around $2,800 a month, or sorry, a year, right? But also I put a lot of money into the renovating this asset, right? I was basically renovating a bunch of mobile homes, right? Sorry, I lost my train of thought there. So, for example, for me, I put about $180,000 in renovating my mobile homes. And when you go through this asset, so let's just say, so in the prior year, I spent $180,000 to renovate it, and that's spread over 5 years, right? So renovation, 180 divided by 5. So that's roughly about 36K that I was writing off. So when you go into depreciation section, so let's say I want to write for depreciation of my the structure as well as the renovations. It's going to ask you questions, right? So you click edit, click continue, and it's going to ask you, tell us if you stopped using this item for business purpose in 2023. And select yes if the item was sold, stolen, destroyed, converted to personal use, given away, or taken out of service for any other reason. So I sold it, so I click yes, right? So for me, it's going to ask you, okay, what date did you sell this property? So for me, I sold my mobile home park on October 1st of 2023. So that's the date I'll put in. And then from here, it's going to ask you a few more questions, but this is the tricky part. So now it's going to say, enter the following information about the sale of this asset. You must divide or allocate the sales price and expenses between the land and the asset improvement based on their fair market value. So this is the part where I messed up. But because I Googled it on TurboTax, someone else in the same situation, it made it a lot easier for me, right? So I think for me, I can share my screen on this one. So here it's a little bit small, but so I kind of did some calculations here. So basically, let me see. So this is how I kind of broke it down. So I basically sold my mobile home park for about 1.55 million, and then my total expense to sell this park was about $9,800, right? So this is my sales price. This is my sales expense, right? And then I broke down everything into, okay, this is improvement. So I spent $180,000 on improvement. The land, I basically bought this for $1 million, and then the mobile home parks, basically this seems off now that I'm thinking about it. Oh, no, this is correct. So the mobile home park structure, was $100,000, right? So I spent, to recap, I spent $180,000 for renovating the mobile homes. The land, I bought it for $1 million, and then the structure was $100,000 for all the mobile homes that I inherited. So my total all-in cost was about $1.28 million. At this point, I want to figure out what the percentage is. So out of this $1.28 million cost basis, what percentage of it is improvement, which percentage of it is land, and which improvement of it is the structure? So it's simple math, right? So I just literally take this number, 180K, divided by 1.28 million. So that comes out to be 14%, right? That comes out to be 14%. And then for the land, as you can see, the majority of the land is the value, right? So I just take 1 million divided by 1.28 million. So it's about 78% for land. For mobile home park structure, I just take 100,000 divided by 1.28 million. So this is about 7%, right? So what I do is I want to allocate the sales price to each of these three categories. So what's the sales price for the improvement, for the land, and for the mobile home park structure? So I just take the sales price of 1.55 million. I'm going to times that by this percentage. So for the sales price that attributed to the improvement, I was roughly 217K. For the land, it was roughly 1.2 million. And for the mobile home park structure, it was 120K, right? So it's just a simple ratio. And same thing for the sales expense. So for the sales expense, I want to take my total cost of $9,800, times that by 14%. So the expense related to the improvement was around $1,300, and so on, right? So I wish TurboTax did this for me, but since it doesn't, it's just basic math. And if you get an Excel document, it makes it a little bit easier to basically see that. So let me stop sharing my screen. So basically from there, I would take those numbers and put it into each section of TurboTax. So it asks me, okay, what's the asset sales price? So for me, what's the asset sales price of the structure, right? So that's $120,000, and the asset sales price expense was $766, right? So, there's basically a ratio for there. And then what's the land sales price? So I put 1.2 million. And then what's the land sales expense? That's about 7,700. So I'll put that information there, right? And then now you have to finish this depreciating asset. And then because you have different categories, now you get to go to the renovation, which is the improvement, and do the same thing, right? So you're going to click edit. And then at this point, you're going to say, I sold it, date sold. And then you're going to put down, okay, what was the sales price related to this improvement, and what was the sales expense, right? And then when you go through this, it's going to give you a number at the end. At this point, it can ask you too, do you want to do an installment sale? So let's say you did a seller care second note, which I did. It'll ask you, do you want to do an installment sale? And basically you pay the taxes later. I didn't want to do that. I just want to pay the tax now. But for example, for me, it says that for my renovation on my mobile homes, I had a gain of $100,000, right? So when you sell an asset, basically it's depreciation recapture, right? So it's basically calculating your depreciation recapture. So if you made money on a sale, it's going to add to your ordinary income, right? But so for example, I made $100,000 by renovating my mobile homes and selling at a higher price. However, for the land and the actual structure, I lost money on that one, right? Because let me click through the numbers just to show you. Actually, kind of a bad example, but yeah, this one it says I had a gain of 26K as well. So when you sell an asset, what happens is it'll calculate all your depreciation recapture, right? So if you made money on selling the asset, right? So you just punch in your cost basis and then what you sold it for, right? Minus the expenses, divide up into each percentage that I showed you earlier. And then what also happens is all of the passive losses that you had. So I had passive losses from the prior year and passive losses from this year. All that falls this year, right? So the passive losses from last year and the passive losses from this year was a lot higher than the gains that I made by doing depreciation recapture. So that kind of offset each other, right? So I ended up being negative $100,000 total. So after all the depreciation recapture, after all of the passive losses that became active this year, I was negative $100,000. So I lost $100,000 on my mobile home park, right? But one thing that I didn't realize was that negative $100,000 on my mobile home park offset my W-2 income by $100,000. So yes, it sucks to lose that $100,000, but actually it was a little bit less for me, because if, let's just say I made $200,000 by having through W-2, by having that $100,000 loss at the sale of my mobile home park, it actually reduced my taxable income from $200,000 down to $100,000. So because of that, my tax bracket rate is roughly 30,000 or 30%. So basically, I got to write off $100,000 loss against my active W-2 income. So basically, I got back I'm getting a $30,000 tax refund because I overpaid $30,000 in taxes. So in a sense, by losing $100,000 on my mobile home park, it helped me regain $30,000 of the taxes that I paid through my W-2 job. So in a weird way, my actual loss, if you factor that tax benefit I gained from losing, my true loss was around $70,000, right? So don't get me wrong, I still lost $70,000. I'd rather make money and pay taxes versus lose money and then gain back taxes because it offsets my W-2 income. But it kind of validated that, oh, it's kind of nice to have a W-2 income, right? Because this was taxes that I was paying anyways through my W-2 income, and I had a negative $100,000 loss. So great, right? Like I got back $30,000 of taxes, so it just buffered my loss a little bit more, right? And same thing with my business. If you're negative K1, that offsets your active W-2 income as well. So yeah, it was kind of an interesting thing to see all that play out, right? So like to see the depreciation recapture and how that was a gain, right? But also how all the passive losses that carried over from 2022 and all the passive losses that I have from basically 2023, right? Like that offset all that depreciation recapture. I was net negative, and that net negative offset my W-2 income, right? And let's just say what happened is, let's just say I made $200,000 through W-2, but let's say I lost $300,000 on this deal, on the mobile home park deal. What would happen then? In that case, it would basically wipe out my whole $200,000 income, right? I'd be negative $100,000. So out of $200,000 W-2, I probably would have paid $60,000 in federal and state tax. So I would get a refund of $60,000, and that negative $100,000 left over will carry forward till next year, right? So next year, if I make another $200,000, I can carry forward that negative $100,000 loss that I didn't use all of it, right? And that can offset my income for next year for $100,000, right? So that's kind of the silver lining in a shitty situation. And it was quite interesting to see that, to be honest, doing my own taxes. So yeah, that's kind of, I know I went into the weeds. That was pretty heavy. But for me, I've been doing my own taxes for the past, like, since 2017. And every year it's like I learned something new. And this is the first time where I actually sold an asset, because I'm typically a buy hold investor. But just seeing the implications of this, and what's kind of nice is, like, if I want to sell an asset again, I can kind of simulate the numbers on TurboTax to see, let's just say that something I thought of is, let's just say, for example, I made $200,000. I sold my mobile home park for a loss of $300,000, hypothetically. For this year, I'm net negative. I still have in net negative $100,000. I would have gotten back all my taxes that I paid to federal and state tax. So it's $60,000 for simplicity, right? What I could do, if I know, and if I did it before December 31st of 2023, is I could roll over from my traditional 401k into a Roth 401k. Because when you take money out of your traditional 401k, which is tax deferred, into a Roth 401k, it now becomes ordinary income. So you have to pay income tax on it, right? So what you can strategically do is, if I know after selling my mobile home park, I'm negative $100,000, I can roll over $100,000 from pre-tax to Roth. And basically that money will be offset by that negative loss that you had from your real estate, and then you can transfer over to a Roth, and now your money can grow tax-free, right? So this is the power of, like, knowing your taxes and how to maximize it. And you have to do this in the calendar year 2023. I was hoping to roll back by the end of 2024. No, you have to know. So what I'm going to do for next year is, if I know I might have a loss out on the sale of a property, then I'm probably going to try to calculate how much money I can roll over from my traditional 401k to my Roth. Or worst case, if you don't do it, then, like you said, that negative loss carries forward to the next year, right? So it's not truly lost in that respect. So yeah, it's been really crazy. Like I said, I have no tax background whatsoever. I've just been doing my own taxes for the past few years. And, once you do it, what's nice about TurboTax is it takes your information from last year and it carries it forward every year, right? So it kind of reminds you. The hard part is just gathering all your data. So for me, I have a bunch of business banking accounts because I own LLCs, right? So, I have a business credit card, business bank account, and then I just can pull my bank statement and then allocate it towards each expense. For my single family homes that I self-manage, for my 2 apartment complexes and my mobile home park, my property manager gives me a monthly P&L. So typically around this time of year, like February of 2024, they will give me my finalized 2023 total P&L. I just take the total numbers and I add it into TurboTax. So to be honest, like this is what the CPAs are doing too. They're going to ask you for all this information, and then you're going to give them this information. They're going to input it in, right? But then they might know stuff of like, oh, like, do you qualify as a real estate professional? Maybe, if you're proactive and you reached out to your CPA, you're losing money, you could roll over from a 401k to a Roth. Like I said, worst case, you just can do it the next year, right? Like, and it's fine. So, it's kind of crazy. Because, I've always been told like you should use a CPA, but I've had friends where they're like, I had a friend who worked high income W-2. His wife was a stay-at-home wife. He owns a bunch of real estate, and the CPA took them like until like just this year to realize that, wait a second, like we qualify as a real estate professional, but they didn't know it, and they could have taken all those net losses to offset his active W-2 income, and then the CPA was doing the number for him, right? So that's what I mean. Like, is your CPA just crunching numbers for you? If it's just crunching numbers, that's easy. You could do that in TurboTax, right? But if the CPA is kind of guiding you on like how to like do depreciation, on how to do qualify as a real estate professional, how to document your hours, at that point it might be more valuable. But to be honest, TurboTax tells you that too, right? Like TurboTax will say, like if when I get married and I want to qualify as a real estate professional, believe me, we're going to be documenting all of our hours that qualifies as a real estate professional, right? If my future wife is a realtor and she shows a rental or a house or does an open house and she stays there for 8 hours, I'm going to write on a log, Excel document, date. Let's say she did it today, February 19th. This is the property I did an open house for 8 hours, right? Done. You have your proof. Oh, I talked to a client, potential client. Document that 1 hour conversation. Right? You want to document everything so that you can prove that you did at least, I think it's 750 hours as a real estate professional, which isn't hard to get. And it has to be more than 50% of your activity, right? So for example, if you work as a pharmacist for 20 hours a week, you better document 21 hours a week as a real estate professional, right? Like if you want to meet that requirement, right? Or if you do, let's say 10 hours as a pharmacist and you work, 15 hours as a realtor, right? Like it just has to make sense in terms of relation to your W-2 versus your real estate, right? But you want to document your hours, right? Have proof. Like I only work 10 hours a week. That's easy. You can pull up your pay stubs, right? And then for real estate, you can create your own Excel sheet and document it, right? Like say I spent this time doing open house. I drove this client around town and this is what it costed me, right? So as long as you have that proof, you can qualify and save that proof into your tax folder. So for me, I have a tax folder for 2023. So I save all my documents, my bank statements, all that in there. So it helps me keep me more organized. So for me, like you said, if there's any questions that I have, I literally just Google the question. And then I will, usually someone TurboTax will ask it. And TurboTax, you can actually, they have a hotline that you can actually call. And then they'll ask you like, oh, like I have a question. And if you need something in person, if you need an explanation, right? Like once again, I'm not sponsored by TurboTax. I've just been using them, for the past 8 years. And honestly, I learned so much from like just using TurboTax and doing my own taxes myself. It does take like a long time and a lot of concentration. To be honest, like I am procrastinating on my taxes by doing this video. But like, it's pretty user friendly, right? Like for state specific, I think TurboTax is about, I should know this. I think it's like $80 or like 80 to $100, and includes your federal tax return. And for one state, so for me, I do California. And if I want to, because I own a rental property in Oklahoma and I own a rental property in Alabama, you have to pay an additional $40 to have access to that. So it's like pretty inexpensive. to do it. And like you said, the state taxes is pretty easy because they pull a lot of information from your federal tax. The federal tax takes me the longest for the most part, but it's pretty nice in terms of that aspect. So, once again, hopefully you found value from this. Hopefully you learned some stuff at a high level to, empower you to at least ask the right questions if you're using a CPA, and to at least get you, educated about it. Because for me, I always like to, trust but verify. So, like I said, I've been doing my own taxes since 2017, despite owning 90 units of real estate, despite owning, a pharmacy, my coaching business. So I've been doing everything myself. Like the only thing I haven't done is like, oh, did I do a 1031 exchange? And there is actually an option in TurboTax where it says, did you do a like kind exchange? And you just click the box, right? So maybe eventually, if I 1031 exchange one of my single family homes into another property or into another apartment complex, I'll probably document my journey of doing that on TurboTax, and how that'll look in terms of, all the depreciation recapture. That's usually typically deferred. That's why I do 1031 exchange. That's the only situation that I haven't done in TurboTax yet, right? But everything else, I feel like I've had some exposure to it. And with TurboTaxes, it takes a lot of time, takes a lot of patience, and you just get better over time. Like for me, I just slowly improved every year, and you learn a little bit every year, and that's the whole point, right? Like as long as you don't abuse the system, right? Like like for example, for me, I don't write off my car; I just write off mileage, and I'm very reasonable. I don't say I drive to my rental property every day, right? Like if the rental property is, I typically, if it's in Southern California, I drive to my rental property once a month just to check up on it, right? But if it's like, all the way up in San Francisco and I'm in California, I go to those, once a quarter when I drive back up home, to visit my family. Typically I'll drop by the rental property just to check up on it and see how it's doing, right? So at that point you can write off your mileage, and as long as you're reasonable about it and not abusing it. Kind of same for like, if you, let's say like write off your home office, like just like don't abuse it, right? Just be reasonable about it and fair. And typically just know that in the grand scheme of things, like even me, I'm a small fish. Like even though I own 51 units, like, relatively speaking, like if the IRS try to come after me, like the most they'd get is like maybe like 20, 30, 20, maybe $10,000, which isn't much. But they'd rather go after some big fish. You're like writing off a lot of money, right? Like all those huge like real estate investors that they write off a lot. And one thing I kind of want to end on, and sorry, I dragged on a little bit longer than I would like, but for California, if you own an LLC, regardless of, like let's say my rental property is in Oklahoma, I have a LLC in Oklahoma. California doesn't care. You have to pay the franchise tax board $800 a year if you operate a business. You're based in California, and you operate a business even if it's somewhere else. So for me, I own 6 LLCs. I went a little crazy. So every year, I'm getting back like $30,000, but I'm about to write a check to the franchise tax board and pay them about, for all my 6 LLCs, $800. So that's $4,800, right? So every year I come a check. So that's why I've kind of hampered down on a number of LLCs that I have because I went a little bit too crazy. I mean, you want a balance of like having asset protection, but also like not going too crazy LLCs because it can start to add up, right? But that's just the cost of doing business, especially when you do real estate. So for me, what I personally do is if I have a apartment complex that I'm renovating, that's riskier. That's in its own LLC. But once I'm finished renovating it and it's stabilized, I'll transfer it to my other LLC with my other stabilized apartment. And then I will then get rid of that LLC, right? Or if I own enough, let's just say my LLC has maybe too many units in it already, then at that point I'll just keep the LLC, right? So I'm a little bit cognizant of that $800 a month cost, but it's really up to you and your tolerance. Like for me, I don't want it too complicated for that. So that's just my personal preference. But talk to asset protection attorney. But of course, they want you to get more LLCs, right? Like they get paid the more LLCs you have. So for me, I found it kind of a happy medium because like my rationale was, okay, someone puts a 50-unit apartment complex in its own LLC. I have 2 25-unit apartment complexes. Like, why can't they be together, right? Assuming they're stabilized. Like before they were separate when I'm renovating them, but once I'm stabilized, I consolidate into one LLC. So both properties are in the same LLC now, and I got rid of the other LLC. So now I have to pay $800 a month. And worst case, if I want to open another LLC, it's cheap, right? You can do it online for like $300, right? So if I want, it's easy to get more LLCs. It's hard, but it can get expensive if you own too many LLCs. So, don't make my mistake and go too crazy. So once again, hopefully you found value from this session. I've been doing my taxes this whole past 2 weeks, so this information is fresh for me. So hopefully you found some value from this. Hopefully you learned a couple things about taxes, and hopefully this will inspire you to, go on your real estate journey. If you want to, join my mentorship program, check out the links down below. Happy to have you join and learn real estate and build wealth. So thank you so much for hopping on, and I'll see you guys next week.